Quick note before we begin the episode. Episode 200 is fast approaching, and to mark the occasion, Hussam and I will host a special Q&A session with questions from you lovely treasurers. Click on the link in the show notes to submit your question, and we will even send a $10 gift card for our favorite 5 questions. It can be about careers, treasury, corporate treasury 101, or even what Hussam's favorite ice cream flavor is. Deadline to submit your question is December 15th. Have a lovely episode. Welcome to the Corporate Treasury 101 podcast. In today's episode, we discuss treasury challenges in a sub-investment grade company and more with Karen Van Den Driessche. Karen is a treasury veteran with 25 years of experience in the treasury field. And she also is the president of the ATEB, the Belgium Treasurers Association, for 9 years now. In Belgium, the Association of Treasury Experts brings together finance and treasury professionals, fostering collaboration and knowledge sharing to elevate the treasury field and fortify the nation's financial landscape. In the episode of today, expect to learn what being sub-investment grade as a company actually means, especially for the treasurer, what financing alternatives can treasurers use when a company is downgraded to sub-investment grade, how can treasurers manage high borrowing cost post-downgrade? How can treasurers mitigate the impact of a lower credit rating? What skills and tools are essential for treasurers in a sub-investment grade setting? What is the role of the ATEB, the Belgium Treasury Association of Corporate Treasurers, and what do they do? And like always, much more. As one of the rare in-person interviews that we did, this one definitely didn't disappoint. Karen is truly amazing, clearly knowledgeable, and rather fun to talk with. Plus, the topic we tackled is honestly quite original, and we feel very lucky we could interview Karen openly about it. We hope you will enjoy the episode. If that is the case, and when you're thinking about how you found our podcast, chances are that it was through word of mouth, social media, or a recommendation from your favorite podcast platform. And this is our only request to you. The best way you can support the podcast is to head to YouTube and subscribe to our YouTube channel, Corporate Treasury 101. That will mean the world to us, spread the word, and help more people learn about treasury. On another note, this episode is brought to you by Automation Boutique. Automation Boutique is empowering treasury, finance, and risk management with tailored automation solutions. They use robotic process automation, or PA, AI, APIs, and Power Query to create automations that can work with your existing systems. We partnered with Automation Boutique as we really like their approach to innovation and how they help the industry. For this partnership, they came up with an AI-powered automation self-scan that can help you find out if a business process is suitable for automation and how to best get started. It is totally free, non-intrusive, and only takes about 15 minutes. What's great is that the report you will get from the scan helps you determine if the benefits of the automation outweigh the costs. If you want to have a look, head to the link in the description or to automationboutique.com/corporate treasury 101. And with all that being said, please welcome Karen Van Den Driessche.
So Karen, thank you so much for coming to the Corporate Treasury 101 podcast.
Thank you so much for having me.
Could you start off by just introducing yourself?
Yeah, my name's Karen Van Den Driessche. I've been active in the treasury profession since 1997, so a little over 25 years ago. I've worked in different roles and in different organizations. I'm not just active in the treasury profession. I really am passionate about it. I think that's what drives me. So I am driven, I'm strategic, and I'm really committed to empowering teams to deliver the best of themselves. I enjoy interacting with people. I like to share knowledge and ideas, but I also like to have fun. So while I work really hard, I do enjoy traveling, spending time with friends, reading a good book, having a good glass of wine. So I really like to enjoy both sides, work and play.
Amazing. Okay, so we're going to talk today about sub-investment grade companies and the role of treasurer in those kind of companies. So can you start off just by defining that term? Like, what is a sub-investment grade What does that actually mean? And how does what's the opposite of that? What are the other grades, I guess?
Okay. Well, I'll probably walk you through a little bit what the grades are. But in essence, I mean, most companies receive a rating according to their financial strength, their prospects, and their past history. So companies that have manageable level of debt, good earnings potential, good debt paying records, they will have good credit ratings. And they will be considered what you call investment grade. While the other side of the spectrum is actually being sub-investment grade, which means that the quality of your company's credit is considered low and that there is a high risk of default. So that is in essence the difference between investment grade and sub-investment grade. So the investment grade level to which a company belongs will refer to the quality of the company's credit. And to be considered investment grade, the company must be rated BBB or higher by Standard & Poor's and Baa by Moody's. Anything below those ratings would be considered non-investment grade. And there are rating scales, right? So you have Fitch and S&P and Moody's, which are the three main rating agencies that people know. There are other rating agencies. For example, there's a European rating agency, which is called Scope, which is actually focusing on more European corporates. The way they look at it is they say we have a better view on how European corporates work, and they incorporate that in their model, but it's not as known yet as the three big rating agencies.
Interesting. Do banks look at those? Because I never heard of Scope. Yeah, Scope.
No, actually, I had a meeting with a bank a couple of weeks ago, and I mentioned it, and they had never even heard of it. But actually, it's a very big one, and they work for a lot of banks themselves. So I don't think they're to be underestimated. Not that I'm making.
We are not sponsored by Scope.
No, not at all. But I was also interested when they approached us, and
yeah, that's interesting.
So there are other players out there.
And the model is the same, I assume. It's like companies pay to get a rating.
Yes.
Then okay,
that's the worst part of it. You pay.
Of course, they do. Very cool. And so you quickly touched upon it, Karen, but what does a credit rating imply for a company? So you said based on the financial strength, and then you're either investment grade or sub-investment grade. Mm-hmm. But what does that mean for the company in the details?
Well, I think a credit rating is a forward-looking statement, right, about the creditworthiness and the credit risk of an organization. Mm-hmm. So, it looks at particularly whether an organization is going to be able to meet its financial obligations. So it indicates the likelihood that you're going to default on your debt payments. That's in essence what this rating means. So if a company takes on more debt than it can manage, or if its earnings outlook weakens, then that will usually lower your company rating. If you can find ways to increase your earnings, if you can find ways to reduce your debt, that will usually lead to an increasing rating. Now, I think it's important to know is that it's much easier or much quicker to lose or to be downgraded than it takes to be upgraded again. So, within the profession, we always joke, one mistake and you're downgraded, and you need to show for, 5, 6, 7 consecutive quarters that you're actually delivering on your results to have a chance to being upgraded again. So that is sometimes hard to understand, especially when you talk to your CFO or your CEO. It's like, yeah, but we've managed to show good results, yes, but not long enough. It needs to be there for a long time before we think, or before the rating agencies think that it is sustainable and it improves your rating.
Interesting. And so when you get downgraded or upgraded, so you said there are different scales, right? Moody's, Standard & Poor's, Fitch all have their small tweaks. When you get downgraded, do you just go one rank below? And same when you get upgraded, or can you go from A plus to C minus?
Theoretically, you can.
Okay.
Right? Theoretically, you could go from being a prime investment, a AAA, to a C. Usually that means that something really went wrong. That doesn't happen. Okay. And also, you don't necessarily get downgraded immediately. You could get a negative outlook. So you maintain the same rating, but you have a negative outlook, meaning you need to be very careful, because if you don't address certain KPIs or certain metrics, that would mean that you would then get downgraded.
Is that publicly disclosed, that this company has got a negative outlook?
Yes. Yeah, just part of your rating. So it's part of your rating.
Okay.
Yes. But usually it's like one notch. And what also happens is the rating agencies have a annual review of each company that they track or that they follow. And usually the outcome of, I mean, in our case, we're rated by both Moody's and S&P. It's very uncommon to have a different rating. So you're usually in the same. It does happen, and that's what they then call a split rating. That's a terminology that is being used, is that if your credit is qualified differently by one rating agency versus the other, and then you could be, I don't know, considered as speculative from one rating agency, but highly speculative from another.
So why do you get more than one rating, though? Why would you, as a company, go out and get more than one? Is there advantage to that? Are you hoping for a split?
There is. Sometimes you could be hoping for a split. But there are also investors, in order for them to be able to invest in your stock or in your debt, want or need to have a company or the debt being rated by two rating agencies.
Okay.
Interesting. So you could have three if you wanted to, but again, remember you pay to get rated. So, and it's not cheap, but usually people get rated by two companies to have that comparison.
And do certain lenders prefer certain rating agencies, or are they all largely seen as the same, the three of them?
They're largely seen as the same. I think the bigger ones, but I think it's also historically are Fitch and Moody's. Moody's and S&P. And then you have Fitch, which I guess historically came in the picture later. It's also a Canadian agency, so maybe more used in other markets. And then you have, like I mentioned, Scope, and there's definitely others. But so there is a change in the landscape of the rating agencies, but I do think the three ones that have been historically there are still the standards.
We had Alex Griffith from Fitch Ratings on the show, and he was explaining that in the process of rating companies, there is this exchange between the corporates and the agency.
Yeah.
So I understand why, as a rating agency, he would say that, but we're interested into getting the corporate side and point of view. Like, is there a real exchange between you or a treasury department and the rating agency, and what's the dynamic exactly?
There is a real exchange, yes. Okay. So we speak to our rating agencies probably every 6 months. I mean, again, it depends on what rating you have, right? I mean, if you're an investment grade rating and you're, I don't know, AAA prime, maybe you don't talk to them as much from our perspective. So we talk to them regularly, like every 6 months. We have an official annual review every year. So yeah, like I said, there is a real exchange of information. So we sit down regularly with our rating agencies. We present to them our financials. We look at the time we do our budget for the year. We will review that with them. We will review our strategic plan with them. In our case, we've had a lot of what we call non-recurring expenses as a result of reorganization. So you explain in a little bit more detail to them what is behind the numbers. So I think you're more open to your rating agencies than you are to the external world. So the information you give is not public information. So there is a real exchange. And then you also, as a company, so rating agencies issue reports. And so when there is an event that happens, they might issue an ad hoc report, but once a year they will issue a report either reconfirming your ratings or upgrading you or downgrading you. You do have, as a company, always the final say in what is mentioned in that report, not the result or not the outcome.
Makes sense.
But how it is worded, how it is phrased, what you want them to disclose, what you don't want them to disclose, you have final say as an organization in what is being published.
Interesting. And in cases where you have two rating agencies, first of all, do the two rating agencies communicate between each other about their clients? Okay. And when you get
at least not that I know of. Let me put it. I was very direct.
That,
no, but at least
not
that I am aware.
Well, I think we can trust your word on that. And in the meeting that you have with them, is it the two agencies at the same time, or here again is one and the other?
Yeah, completely independent.
Interesting.
So you could theoretically decide that you want to say more or less to one agency than the other one. Again, from my perspective, we try to be as transparent as possible with both of them. We have a good relationship with them. Like I said, I don't always agree with what the outcome is, but we have good communications with them. and they're very clear on what they expect. And so they are also saying like, okay, if you want your ratings to be upgraded, those are the metrics that we're looking at. And we actually know exactly how they calculate, because I would say it's like if we do a projection of what our leverage will be 6 months from now or a year from now, it's based on our official numbers. It's based on the way we calculate leverage. The rating agencies have their own way of calculating it. They take certain elements into account. They disregard certain elements. They take a buffer on numbers that we presented. So they come up with a totally different rating, but it's their rating and it's consistent. So we've spent, for example, in my case, a lot of time with them understanding exactly what they take into account, what they don't take into account. And they only work officially on published information. So whatever we tell them, they will take that into account. But when they calculate their metrics, it's really based on publicly available information.
Interesting. Do you see a difference when you're working with the different agencies? Like, do some ask more questions? Do some go in more detail? Or do they even focus on different things? And you kind of see, oh, this one's rating is kind of more focused on the debt aspect, and this one is a little bit more focused on the operations aspect. And
no, not really. I think the principles. So yes, of course, the questions they ask and the level of detail some go in are different, but it's all based on the same metrics. So they look at cash flow and liquidity, at debt. So that is really not very different. Understand? And I think it also depends. It's like if you're the person who follows your file has been on the file for a long time or a little bit less. I mean, so I guess that depends also on what type of questions you ask. If they've known you for a long time, I mean, they also know exactly what the business is about. But it is interesting conversations, and you keep them up to date about things that happen. So, for example, if you would do a press release about a senior member of staff leaving in the organization, it would just be a basic press release. However, when you then talk to your rating agencies, you will give a little bit more color and explain a little bit, and they will identify whether they see it as a problem or not.
Interesting. We're going down the rabbit hole here, but love it. Can you have 3 ratings eventually? Is there any interest in doing that?
Well, we talked about split ratings earlier, right? I mean, so you could decide that you wanted to have a third rating, because then you could take the 2 highest and the lowest rating.
the third one's still public.
This third one is still
So any investor can still go and find the other one.
Yes.
You've touched upon it a bit, Karen, but what does so we understand now what credit rating means for the company itself. And as we are leaning towards the second section of this interview, what does it mean for the treasurer? Like, what are the implications for you as the group treasurer of a company when it comes to credit rating?
I think if you have a investment grade rating, and I think I mentioned this before the show to you, again, and everything I'm saying is from my personal experience, of course, right? So I'm not saying that this is true or not true, but this is from my personal experience, is that I used to work for different companies, which were all investment grade companies, which were at the top of the investment grade. And I never really realized or paid attention to it. So from a treasury perspective, again, in my view, is I only started noticing the impact of being sub-investment grade by working in a sub-investment grade company. So that's when reality really hits you. So I think the treasury challenges for sub-investment grade companies is mainly access to liquidity, and then secondly, the price you have to pay for that access to liquidity. And one of the thoughts I had when I joined a sub-investment grade company is like, well, I need the money to be able to drive my business. Well, before, and I'll talk about banks in general, they would maybe overreacting, but they would throw money at you when you didn't really need it. Now that you need it, they don't want to give it to you. So it's like, and I understand the whole idea behind it, but it is frustrating sometimes is when you're in this organization, it's like, but this is now when I need it, and before I didn't need it, and you give it to me. So it's a little bit difficulty. So I think that's important in sub-investment grade, is this access to liquidity, is it access to funding, then the price you have to pay for it, but then also operationally, right? I mean, you as a treasurer will look at the rating of your counterparts to assess the risk. Our suppliers, our customers, our banks do the same, right? And so an impact or consequence of being sub-investment grade, or maybe moving from investment grade to sub-investment grade or down the rating scale, could be that your suppliers don't want to take any risk on you anymore, or less risk, which means that they will shorten their payment terms, which has, again, an impact on your working capital. So very often, by getting a downgrade, it has a lot of implications, because it's not just your cost of funding, let's say, but it's the access to funding purely from a financing perspective. But financing is bigger than bank financing or external financing. Financing is also your payment terms. How quickly do I collect my money from our customers? How quick do I have to pay my suppliers? And if I have to pay my suppliers in 30 days instead of 90 days, I'm losing credit from that side as well. So I think that is probably something that people tend to forget, is there's the real, what you would call core treasury aspect of it, but there's a whole operational aspect of it as well that you need to take into account.
Super interesting. Do you see any impact on the client side as well for the collections? So payments, we would understand why. I mean, it would make sense that the supplier sees a bit of risk and is like, okay, let's shorten the payment terms.
Yeah.
On the client sides,
there could potentially be, because from a client side, maybe not necessarily on the financial flow. However, a client can be concerned that because you might default, because your risk of default is higher, that you're not going to be able to deliver them products anymore, right? So they have a more risky supplier in front of them. And if they buy from one supplier, their risk goes up. So it might mean that they would have to diversify suppliers, which could mean a loss of business. But I think that is where, and I think maybe we'll come to that at some point during the interview, but I think that's where it's really important that whenever, and I'm thinking again more from moving from investment grade to sub-investment grade, but what I think is more important within a sub-investment grade environment is that there is really open communication within your whole organization, so that they know what the implications are of being considered risky or a higher likelihood of default.
So your day-to-day treasury operations as a treasurer, like being sub-investment grade versus not, like how does that impact the day-to-day role that you do?
Well, being sub-investment grade as such, as long as there's no change, doesn't necessarily impact my job, right? I still do the same type of things. I need to make sure that I have access to funding, that I have liquidity in the right place at the right time. So that in essence doesn't change the role of treasury. I mean, it's the constraints within, I'm going to repeat myself again, this access to liquidity, that is the constraints within which you work. But I don't think there's a big difference in being sub-investment grade or not.
The transition was the hard part?
Yes. So in our case, we were so again, when I joined this organization, we were already sub-investment grade, but we have moved down the ladder since in the last 2 years, which was a result of COVID, which was a result of the commodity price spikes and increases. We had supply chain issues. So as a result of that, we have had a couple of downgrades. And so then, yes, you see the difference because your access to liquidity becomes even harder. You might have had financing or alternative financing sources in place for a working capital perspective that then banks do no longer want to offer you. For example, supply chain finance. Your factoring might be at risk, even issuing bank guarantees, right? Because a bank guarantee is a form of credit that the bank gives you, so they might be less inclined to give you that additional credit. So yes, by reducing your credit has an impact. Once you're in that situation, I guess you know what you deal with.
So talk us through that journey. Like when you do move your grade on your ratings, like is it overnight? Like all of a sudden you wake up and you got 15 emails from your different bank partners and say, hey, this just got announced. We need to have a chat.
Well, that would be nice if it would be, we need to have a chat. The email is your intraday limits have been cut.
Today?
Yes.
Jeez. I know what you do.
Yeah.
Then you live with that.
Tell the trucks to stop.
You first, again, coming from an investment grade, I would yell and scream. I was like, this is totally unacceptable, but okay, this is your new reality, so this is the way it works. And fight conditions.
Because when Moody's gives you, let's say, announce the rating, do you get it before the public does, at least? Yeah. So at least you know, okay, this is coming.
Yes. And you don't know what is going to be the actual impact, right? Because banks have their own ratings models as well, but they still rely very much on the official rating. And it's not like the news gets out or gets published and the following day you have that. But you do know that once this official rating is out, that there will be impacts on your banking facilities, there will be impacts on your suppliers. So you will know that, because a lot of our suppliers have actually credit insurance in place, right? So, but the credit insurers also use this rating. So they will downgrade their assessment and therefore provide less insurance, and therefore suppliers will reduce your payment terms. So you do know if an action like that is announced, that you have to, like, I don't know, put everything aside, because you will need to try to convince your suppliers. And then again, it's coming back to that communications, being very connected with all of your procurement team, getting on calls with suppliers, and credit insurers, explaining to them or trying to convince them not to follow the credit rating agency's actions and to continue to maintain the credit.
How much time do you get between when you know and when it's public, and then when the banks adjust their internal? Like, what's the time period?
Between when we know and it gets published, probably 2 to 3 days.
Really? That's short.
Yeah. They do their assessment, they tell you, but they I mean, let's say within the week it gets officially published.
Okay.
And then that really depends on the bank. I mean, I always say, if I have a very good account manager who can manage the internal bank credits committee, not to do anything immediately. So then it really comes down to the relationships you have with your bank, how risk averse they are. I mean, so then it becomes a little bit of a negotiation process. But once they have taken their decision, then it's almost an immediate impact on whatever they provide.
How do you, so it's a bit business strategy, I assume, but how do you get out of this? In the sense that the way you explained it, it sounds very much like a vicious circle, because the banks cut the liquidities, cut the intraday limits even. So what happens to your cash pooling? The suppliers request you to pay earlier. The clients might be saying, hey, look, we want to keep doing business with you, but maybe we're going to do a bit less. I mean, you're getting the water cut from all the sinks. That's maybe a French expression wrongly translated. But how do you go from, okay, we just got downgraded and we got our supply of money cut, more or less, to let's get back on track and let's...
Well, I think there's probably two elements to it, right? I mean, why do you get a ratings downgrade? Is because of your business environment, right? I mean, so what you do, and that's not a treasury activity. I mean, that's your organization, right? Is you try to figure out is how can you increase on those earnings again? How can you? So I think, how can you increase your earnings or earnings potential, and how can you reduce your debt, right?
Okay.
So, and I think it really depends on why were earnings down, right? It could be that you lost business and you had, I don't know, a quality issue or something like that, depending on which company or what happened. It could be like in our case, it's just the whole market was again, the commodity prices went up by, I don't know, a significant amount. So you ride the wave, I guess. If your input costs go up, you try to push that pricing through to your customers. I mean, I think that's not something for us as a company. It's what's happening, or what has been happening over the last 2 years in all industries, right? I mean, you try to push your pricing to the end or to your customer and then to the end consumer. So you try to get your margins back to the same level or up. You look in your organization, where can you be more efficient? Where can you do more savings? I mean, so you look a lot internally as well. It's like, where can we become better? And as a result, hopefully, as you being more efficient, trying to push your decrease costs through to your customers, your margins improve, you generate cash, and you use that cash to pay off your debt. And then I guess depending on what company you're in, is like sometimes you would look at, okay, is my strategy the right strategy? Again, it's like, do I want to continue investing in, I don't know if you have 3 or 4 different type of businesses, right? Do I want to be within those 4 businesses, or do I maybe want to divest one of my businesses and use that cash to repay debt? So there is no one answer fits all. It's just like, and that's where as an organization, I mean, your management team and your board, I guess, decide on, okay, what is the strategy going forward? Now, not all companies will ever be investment grade. There's certain industries, certain type of organizations where, I mean, if it's a more capital intensive industry, it's okay to be sub-investment grade. I mean, because the returns for your investors are better as well, right? I mean, they'll get more. It's also, I mean, the whole investment market, you have a little bit more risk, but you have some more returns. So there will always be companies at every spectrum of that scale, which is fine.
Yeah. And as a treasurer, is there anything you can do actually? And how does it work exactly? Like, if it comes down to the repayment of debt, maybe you are part of those strategies discussions saying, hey, okay, we should really focus on this debt because it's more expensive than the others, or it's not used as it should, or what happens there?
Well, I think as a treasurer, there's a couple of things you can do. I mean, first of all, of course, try to manage your treasury as efficiently as possible. Mm-hmm. I mean, as soon as you have money, repay your debt, invest whenever you can. Make sure you have the right capital structure in place. I mean, can you move, and maybe it's not at that time, but before, is have the right balance of fixed and floating debt in place, right? So that when you're downgraded, maybe your fixed rate debt won't be affected by it, while your floating usually is if you have like an RCF or something, because it's going to have your margins going to be impacted. So those are things you can do. I think from a treasury perspective, what you can also help on is, okay, because sometimes your earnings are really affected by what we were saying earlier, your commodity prices, energy prices, your foreign exchange fluctuations. So how, as a treasury department, involved are you in managing that risk, whether you hedge or don't hedge, or you buy certain products? Can you work with your procurement team to have like fixed clauses in your contract where prices don't get pushed to you? Those are like a more, well, I would say the first one is like what type of debt, and make sure that that's investment, that's your core treasury. And then I think what is really important for me is being a business partner. I think treasury can do a lot of things in their ivory tower, but if they remain in their ivory tower, they won't be able to address a lot of that. Treasury is not going to change the earnings, right? That's not our remit. I mean, but we can help. And I think the most important message or action that Treasury can do is make sure that the whole organization, so it comes down to communication, right? Is make sure that the whole organization understands what the metrics are. What is it that gives us this, I guess, limited access to funds, and what can we do as an organization to help on that? Like, what are the important metrics? And it has to really trickle down to the lowest level in the organization, so that even, I don't know, somebody who works at the production line, you could say it was like, why does that person care what metrics we have? Well, if that person understands that whatever he can do to make his line or her line run more efficiently and to have a higher output from that line, less downtime, will improve our inventory, will improve our working capital, and therefore will improve our cash position. So it's really going down to that lowest level and making sure, and that's, I think, the core value that Treasury can bring, because Treasury can be core value in their ivory tower and not talk to the business at all. But I think that's where you have a value add. Again, just for me.
No, but that's good. So there is a real, I humbly said, education role for the Treasury Department to make the whole company understand how to actually together potentially upgrade this credit rating.
Yeah. And I think whatever the name is called, there's a lot of companies who have, I don't know, cash is king programs, or I don't know, whatever names are being given to it. But it all comes down to the same. It's like, understand why cash is so important in your organization and make sure that is being trickled down.
Karen, you said at the beginning of this interview that you're very passionate or passionate about treasury. And we had a question around a personal anecdote, but I feel this whole interview is also about you explaining what you've seen in it. We're interested in understanding what do you see as being one of the biggest challenge working as the group treasurer of a company that is sub-investment grade, but is there any fun in it as well? Like, what do you find challenging but interesting? What is, in your opinion, the pros?
I mean, there's a couple of things. So some things are fun, some things are less fun. I'll say. I think the biggest challenge for me, well, there's a couple, but would be, I mean, what keeps me awake is that we have external debts, right? Which will need to be refinanced at some point in the future, and the question is, will I have access to liquidity and at what cost, right? Because, I mean, it's this vicious circle, which you referred to earlier, is like, yeah, but you're higher up or lower down the rating scale, so you have less access to liquidity or at a higher cost, which means you have a higher interest expense. So your free cash flow goes down, so you have less cash available to repay your debt. So you're in this vicious circle. So that is something that does keep me awake at night, is like, and I'm sure for our bankers who would be listening to this, I'm sure that we will come to a good outcome. But that is a challenge that I'm thinking is like, okay, what will be the right time to refinance our debt? Will we be able to do it at a reasonable levels, especially given the rates or the base rates that have increased? So that is, I think, a challenge for me. I think the other one is that you need to make choices, right, about where you invest your funds. And so the choices usually totally logically go into the business, right? But from a treasury perspective, I just look a little bit selfishly. It's like, I don't have a treasury management system, so I'm not very efficient in my treasury system, in my treasury organization. So would I love to be more automated, have more systems in place? Yes, but that requires an investment, time, money, people, which I don't have the luxury of investing that into my treasury organization. So it's a little bit in this vicious circle, is that you're not necessarily as efficient as you could be, but you don't have either the time or the resources being people/money, to invest in that. So that's a little bit the frustration from my perspective. I'd love to be state-of-the-art treasury. Unfortunately, that gets a lower importance level than getting the business running. So I think that is definitely one of the things. We refer to reducing or the credit limits or intraday limits being cut or being reduced. There's nothing fun about that, and there's nothing positive that you can get out of it. I mean, it really is totally inefficient workload-wise. Get frustrated because just in our case, we pay our supplier once a month, so it's a significant amount. So because you don't have any intraday limits anymore, you have to pre-fund your accounts, but we still have cash pooling in place, meaning, I don't know, I put $100 on my account to pay my supplier. Mm-hmm. I need to make sure that, one, the files get signed on time, two, that the bank doesn't have an issue and actually executes all of my payments. Because if something happens, well, my 100 that I pre-funded is gone at the end of the day. So I can't execute my payment, so I have to do my pre-funding again the next day. So it's totally inefficient. It creates frustration for the team because they have to do the same thing over and over again. It creates manually. I mean, okay, how much do I need on this account? Okay, let me send that money to that account. Okay, tomorrow I need again the same amount. Okay, let's transfer again. But it also creates frustration at our supplier side. We say we pay you on the first of the month, and then, sorry, we had an issue, so it's going to be tomorrow, it's going to be the day after. So you lose credibility towards your counterparts, where you don't want to lose credibility, and it's not intentional. So those are really the frustrating parts. And then I think, which is something I mentioned totally at the beginning, yes, I'm passionate about it, but I'm also passionate about people and empowering teams to learn, is that it might not always be the easiest or the most attractive environment to attract new people. Because people are concerned, right? They say, yeah, but why would we work for a company that is sub-investment grade and maybe has rating issues and things like that? So attracting the right talent could be challenging. So those are, I mean, a little bit the point that I that I worry about. The fun part is, I mean, yeah, you have to think out of the box. It's like, how do I, with the limited amount of people, resources, money I have, how can I do the best job for my organization? So I think that is definitely fun. And the fact is that, I mean, I don't know, it's maybe your ego, but you become more important within the organization. Treasury actually gets listened to because you are the ones who are saying, no, we're not going to pay this, or yes, you can pay this, or, I mean, that's really at the lowest level. We're definitely not there yet, but at least you get a little bit more power, and you get involved in a little bit, the result of what I mentioned earlier. You need to talk to the whole organization to make sure that they explain what's going on, which means that I don't know if you get the visibility, if that's the right word, but you get involved into a lot of projects within the organization. And in my case, I'm also responsible for working capital, which means I know more about inventory planning than I've ever known before. You talk to you're part of the discussions with your customers, with your suppliers. So it is very enriching, and it gives you a much broader perspective than the treasury aspect.
That's super interesting. Tell us about the skills that you develop in that environment. Or, so if a treasurer today listening is a little bit bored, they think, well, I want a bit more of a challenging environment where treasury is listened to a little bit more, where, yes, it's going to be tough and everything, and I don't get the latest TMS, and I don't have access to all the credit facilities that I do right now. But I feel like it's going to give me, an opportunity to really push myself to be able to navigate that challenging environment. What advice would you give to that person? What skills do they need? How do you find solutions? Or if someone's in that environment right now, what silver lining can you give them? Hey, by the end of it, you're going to have these skills.
Well, I think there's a couple of things. I think to your first point is you already need to realize or know yourself enough to understand whether you would thrive. Maybe that's too much of the word, but that you would feel okay in that environment. Because I think, I mean, again, it's personality. I mean, some people are very good at being maybe very technical within a big organization. I think so. First step I think would be will I function well in that environment? I think that's the first thing, and that's different for every person. I actually didn't think about it. I'm fine now, but I actually never thought about it when I went into when I stepped into this. But I think the other part is really being able to put things into perspective, right? I mean, it's not personal. You're trying to do the best you can. I don't know. I mean, things happen. Be pragmatic. Address the situation as it comes. Don't get overwhelmed. There's not going to be the perfect solution. And you will, I think the other point is you will have to make choices. And sometimes I think, what do you call it? Is it the cholera or the plague? Sometimes you might feel that way when you have to make choices. So those I think are the main, and communication, sorry. I think I mentioned this several times, but I think communication, be open, be pragmatic, and communicate and listen. Listen. I mean, because you cannot do this by yourself. This is not Treasury having the weight of the company on their shoulders. I mean, it is a joint task, and everybody plays their role in that organization. I think those would be, but again, like I said earlier, again, my view, it's fun. You learn new stuff, you get involved in a lot of things, you start to be pragmatic. I wasn't that pragmatic before because I had everything, right? I could do the best, and I'm maybe another one, like as I'm saying this, is that not everything's going to be perfect. For me, everything had to be perfect. I applying the 80-20 rule was really difficult for me. Now it has become a lot easier. So I think those are the skill sets that putting everything into perspective is probably the most important one.
I think it's overall crisis management, right? And the skills to go with that. Yeah. I think the 80-20 rule, for example, is a really good one. Are there any other methodologies that you or frameworks that you came across that's the approach that you take to solving these problems?
No, just apply common sense.
Which is already
something that is missing very often.
Exactly. No, and you get to learn stuff. You mentioned inventory management. That's not something you would typically look into in a traditional treasury department, right? But it's so critical that you get involved.
So my supply chain team will tell me that I have no clue what you're talking about.
Well, that's probably more than most treasurers. So that's, you get to touch upon things that you wouldn't otherwise within the business, which is getting back.
And I think see it as an opportunity, right? I mean, I don't know if you want to remain in treasury for the rest of your life. Maybe you don't want to do this, but if you have any interest of maybe at some point during your career to move outside of the pure treasury area, I mean, this also gives you the opportunity to look at what else is out there. I mean, would I like to do, I don't know, and I'm not directly saying a CFO role, but maybe going into the controlling side, maybe in FP&A, maybe consolidation. I mean, there's so many different roles out there. I mean, you expand your horizon and you learn other things. But coming back to the first thing is you need to be interested in it. If it's not in your nature, if that's not what you want to do, then maybe don't look at this type of roles.
You touched upon it earlier already, but so you don't have a TMS. And we had the questions around what tools and what innovation do you put into this environment? But then I guess probably not many. What are the tools that you actually use in that? Well, Excel, obviously, probably.
Well, we have SAP, right? We have SAP. So we use a couple of the elements from the SAP Treasury module. So we do have an in-house bank set up. And so we use the whole in-house bank module in SAP. So we do have some tools. We do use a lot of Excel, yes.
There's no shame.
Yeah.
No, there's no shame. And I think Excel is a great tool.
100%.
My concern with Excel is the human error that can go in there, sometimes the inefficiency and the risk of losing your data. For example, we have moved that now to our SAP platform, but our whole FX and commodity hedging program was in Excel. All of the information is in Excel. So when I joined, I said, do we have 5 backups of that Excel, please? In different locations on your computer, on the shared drive.
And one hard copy printed out.
So that is my biggest concern with Excel. And so we use the banking tools. So we download all of our bank statements. Well, so there is let's step back. We have an interface. We upload all of our bank statements directly into SAP. So we have host-to-host connections with most of our banks to do our payment files. So it's not like we're in the dark ages, right? So we have a lot of technology. It's just the upgrade of the technology or spending money on going into a fully integrated TMS, for example. That's what's missing. But we do have tools. And then
have 20 key fobs on your desk to log into each bank.
You have the phone now. It's all apps on the phone.
Authenticator.
So, but yes, I still do have that. Yes. I don't have a full Swift connectivity, which I used to have. So no, I mean, it is. But you also, again, thinking or mentioning earlier, you think out of the box. So when I joined, I mean, we needed to have a lot more visibility on our working capital, and it was really hard. So what we've been working on, and so maybe on the skill set part, maybe at this point, and I don't think this is related to sub-investment grade companies or not. I think the skill sets that you require within the treasury organization are changing, right? And so I think we need more, if I can call it, technology skilled resources. And so I have the chance of having somebody in the team who's on loan, I would say, but she's really, and she knows about it. I call her the tech geek. She's really good. But we needed to have visibility on our working capital, so she's built this whole Power BI model, which gives us all of the data. It connects to our PPC and SAP platforms, but it gives you the visibility. It gives our senior management visibility on a monthly basis, how about KPIs. So you start using other skills or other tools to bring that visibility and to have that.
Back to these skills questions, right? Being able to do with what you have and actually come up with ad hoc solutions with traditional tools is a very good one, because then it helps you have a very light version of a TMS to help you report and do analytics. Yeah.
And then I think, again, maybe on tools that are available in the market, There are, and again, the last couple of years with all of these fintechs and all of these new systems that have been built, it's finding there are a lot of tools out there that can help you with a specific problem. Where if you're maybe in a more mature treasury organization, you would rather go for a full-blown TMS or a fully integrated system. I think there are benefits of using more how do you call it, specialist tools for the specific issue that you face. But then it's again finding the one that actually delivers what it promises without too much implementation. So again, I think that is, and it comes back to something that I've always been saying is find a tool to solve a problem you have, rather than, oh, there's this great tool. Which problem do I have? Yeah, but that is very often, I mean, what's going on. So it's like, what is your issue? What is the problem you're trying to solve, and find the right solution for that?
Yeah. Karen, there are questions we would like to ask you to another part of your treasury life. But before we get into this, anything else you'd like to add about sub-investment grade treasury management in such company, skills, advice for people who are in such environment?
I think we've covered most of it. It's fun.
Yeah.
I mean, it's hard work. It's fun, but you learn a lot. Like working in an investment grade company is fun and hard work as well.
For sure. For sure.
So I think it's just like understand the environment that you're in and try to do the best you can in whatever environment you are. I think that would be my last comment.
Amazing.
Super cool. So Karen, you're also the president of ATEB, right? The Association of Treasury Experts in Belgium.
Correct, yeah.
Super cool organization, very fancy name.
Nailed it.
Tell us a little bit about it. What do you do there? What's your role?
Okay. Maybe some background. I mentioned earlier, I've been in Treasury for roughly 25 years. I've been a member of ATEB for roughly 20.
Oh, really?
And ATEB exists about 31 years. I've been the president for the last 8 years or something. The role really, and the mission, I guess, of ATEB, it was founded by, and I think it was 4 gentlemen who actually wanted to have, they had exchange of ideas and information sharing and so on, but they wanted to make it a little bit more formal and give other people also the opportunity to, in a, I call it, closed, friendly environment, be able to exchange ideas. And so that mission or values is still the core of what we try to do within ATEB. So to try to create an environment in which people can exchange ideas, learn from each other, and that way elevate the treasury profession in Belgium.
Super cool. So how do you do that? Like, what does the ATEB do exactly?
So we organize events. We do ad hoc events. We try to organize an event probably every month, which is usually in person. During the COVID period, we were more webinar, and actually we didn't do that much because we were so, I think, tired of being in front of the screen. And so we do organize an event about once a month. Then we have a Treasury Summit, like it's a half a day, that once or twice a year. And then we do some bigger events, like we had a Tech Day in March of this year. We had a full day event with some of the vendors. So different type of activities, but mainly focused on a content topic, whether it's presented by a vendor, a bank, a corporate. So topic and networking activities. So where we really feel that people learn the most from each other and get in touch with each other is at the networking events after an event, or after a topic event, let's call it. We have since last year introduced just quarterly informal after drinks work, where we don't have a formal topic that is being discussed. But we do understand, and the feedback we get from our members is that they really do like that combination of the content topic with then the networking afterwards. They're fine for networking just once in a while, but they really like the content as well. Mm-hmm. And maybe one more that we organize is what we call a snapshot, or a Treasury corporates only event, where, I don't know, a corporate will do a presentation on their organization. What are the challenges they're facing? What are the things they've recently implemented? Where they need help? And it's really corporates only, because it's really this exchange of information. Like, hey, I'm struggling with this. Do you have any experience on that? And then we form work groups. For example, it's like, okay, not all of the people, but a number of people who use the same TMS. I mean, they have a work group in which they exchange information as an IT. So those are mostly what we do.
So I was going to ask exactly that. How comfortable are treasurers sharing their problems with each other? I guess if you take the banks and the vendors out,
then it's pretty
difficult.
Yeah. Now, I think what is important to notice is that, is that ATEB used to be corporates only until probably, well, time flies, but probably 5 years ago.
Okay.
And we were one of the few national treasury associations who did not open their membership for non-corporates. And when we proposed it to our members, there was a lot of discussion because nobody actually wanted to open up membership for other or for non-corporates. We finally got there, but with the agreement with our members that we would continue to organize events that were only for corporates. And so within that only for corporates, information sharing is pretty open. I mean, to give you an example, it's like, hey, I'm doing an RFP with Bank A and this is the pricing I'm getting. What is your pricing?
Yeah.
So yes, very open.
And what are the pros and cons? Like when you were deciding on whether to integrate non-corporate people into this association, to understand a bit the dynamic of an NTA, National Treasury Association. What are we should bring in the banks, the vendors, the consultants because of that? And what were the corporate size of people saying, hey, no, we'd rather keep it between corporate?
Well, I think there's a couple of elements, right? I mean, the pros or the reasons why we brought non-corporates in is because, I mean, it is the treasury, how do you say it, ecosystem,
landscape, yeah.
Right? And there is valuable insight from bankers, from vendors, from insurance companies. And so giving that platform to exchange information makes sense, because otherwise you have only this one-sided view only from a corporate. So that was for us the biggest reason to accept non-corporates. The challenge is that and a bank, a vendor, a system vendor, they're there to sell a product, right?
Yeah.
Correct.
And so it's finding that right balance between being there, exchanging information without them selling us a product. And that was the hardest sell, or the hardest sell internally, is that if a member is too much of a salesperson, they're out.
Okay.
But do they need to be members? Can you not just invite them to events?
They were invited to events. We used to have we still have that, and they were invited, which was our year-end drink. And to the summit, they could also participate, but the other events, they could not.
So why do you need to give them a membership?
Because there is this interaction and this exchange of ideas, which makes sense. I mean, it is important for us to also see a bank's point of view, right? It is important for us to also understand how systems vendor builds his product, what's behind it. I mean, and even to show his products. I'm not saying they cannot be fully commercial, but in the exchange of information, it's not a sales conference, right? They shouldn't be there to sell. And I think we've made it very clear, and it works fine. It works fine. I mean, yes, it is very much respected.
Do you need to enforce it, or do you need to enforce it at some point?
Some, yes.
Okay.
There are some people who
individuals or companies out of interest. Both.
Yeah.
Some companies just have that culture.
Yes. I think it's because it is that company culture, and
very sales orientated. And sometimes it's just a couple.
And sometimes it's individuals that. But overall, I mean, like I said, it's fine. I mean, we've made it clear from the beginning, and also Belgium, and I guess like other treasury associated or countries. I mean, it's a small world, right? So everybody already knows each other, and somebody who would not act out, I mean, he would be called upon not just by ATEB members, but or not just by the corporates, also by non-corporates. They would say, hey, this is not acceptable. So you do see it like sometimes with new people coming in who are new to the, but then there's this, I don't know, self-regulation that happens automatically.
Nice.
So I guess you can't talk about ATEB without talking about the Belgian Treasury landscape overall. So what's that like? So I mean, having lived in Belgium for so many years, like it's a small country. It's just quite close-knit amongst the Treasury community as well. Is that right? It's like ATEB members, you can't just, even outside of ATEB, I guess, you kind of know all the other treasurers. And
yes, although, like you said, I mean, you have a lot of different size organizations in Belgium. I guess if you look at it, I don't know, 20 years ago or probably longer ago, when you had a lot more multinationals in Belgium, so a lot of them have gone. I guess the difference that you have is you have these really big international firms, and then you have, I guess I'll call it my type of firms, and then you have the smaller companies where maybe they don't really have a treasurer, but we then do treasury activities, and that's where, and maybe I can touch on that later, but those are the ones that I don't think we managed to reach. So I think that if you look at who is member of ATEB, it's a segment of the treasury profession in Belgium, and that there is a group that we don't manage to reach. But it is a very tight-knit one, and everybody knows each other, and then even if it's a non-ATEB event, I mean, so there's a lot of interaction there.
And so how many people are in the ATEB, just for us to grasp a bit?
I was going to check before we started, and I think we're roughly at 200 members. So we have individual memberships and company memberships, and then we have the corporate and then non-corporates.
Okay.
I think we're roughly about 200 individual people that are in the membership.
That's interesting that you want to bring in the non-treasury people who have treasury-related tasks or assignments within their role because the group is not that big. Is there any particular motivation for that? Back to the knowledge sharing and...
Yeah.
Okay.
I think, I mean, if you look at a smaller organization who might not have a full-time treasurer, but it's somebody in finance who does treasury activity. And so they're still making payments, they're still collecting money. So I think similar type of activities, maybe at a less big or a smaller scale, maybe less sophisticated. But yes, I mean, I think treasury is happening in some way or form in every company. And so the question is we've tried, but then it's like, how do you find the people? Well, sounds like, how do you find the people who think would be interested in it, or for who we could bring something? And then don't forget, ATEB is we do it as a hobby.
Yeah, it's voluntary base.
So it's not always easy to. I mean, we all have a job, we have family, we have a lot of social activities, and then ATEB is on top, which we all like doing, but it does limit your time that you can actually spend on it or improve.
What missions do you have at heart as the president of ATEB, Karen? Because you've been doing it for so long right now. So what are the things you're particularly proud of that you built within ATEB? What are the projects that you now have that you'd like to see go through? What are the things that matter to you?
Well, I start, and I don't know if that's typical me or typical Belgian or something like that. I start with the less positive aspects. I mean, I think I think there's still so much we could do. I personally think that I have to, no, not I don't think, I know that I have to say thank you big time to my board, because the last couple of years I have not been very present. I've been a little bit preoccupied with some other things. And so I think I personally feel I have lost a little bit. What I want to do is stand for ATEB, make sure that people know ATEB, that they know what we stand for. It's like being really that ambassador of what we can do for the members. So that's something I've lost a little bit, which I really would like to get back into. But again, our board, which has increased since last year, has been doing really a good job of. Amazing. So that's good. So I think coming back is what I want to do is, and I've been saying it through the whole interview, is making sure that people can exchange information, can learn from each other in all openness and honesty, without feeling that there's going to be repercussions because you, I don't know, challenge something or don't agree with something. I think that's, and I think by sharing this information, by being able to have open discussion, it can only increase your knowledge, the professionalism, and that's really what I want ATEB to stand for.
Amazing. Is ATEB visible worldwide?
ATEB is not necessarily visible. Well, I guess it depends how you look at it. So ATEB is part of the EACT, so the European Association of Corporate Treasurers, and is also part of the ICTA, which is the International Group of Treasury Associations.
Okay.
So the EACT actually consists of the European National Treasury Associations, and we all have a affiliation. Well, we're actually all a board member. So every entity, so every local National Treasury Association has a board representative in EACT, and then there are a couple of international organizations, like I think Hong Kong, the US, South Africa, which then form the ICTA, so it's the European plus some others. Now, so within the European Association of Treasurers, yes, we have our voice and our knowledge. I mean, European Association of Treasurers has been more focused on regulatory lobbying.
Yeah.
Right? So there's been, and maybe less visible now, but there is still a lot of legislations that's happening that is impacting us as treasurers. And what we're trying to do with the ACT mainly is to make sure that the real voice or the real economy is heard to our legislators, because they might have legislation that is to address certain things that have happened with the banks. Yeah. But with putting certain legislation out there, it has an indirect impact, and I'm sure legislators are not aware of that, right? But it has could have a certainly negative impact on the real corporates, because banks and corporates are not the same, right? Mm-hmm. And so that is really what the ACT is trying to make sure, is that from a legislative purpose, the voice of the real customer is heard as well. And so that I think is and that goes through lobbying and things like that. And then lately also EACT has been focusing more on education, exchange of information, making sure that, I mean, there's so many, again, knowledge in each of the associations. Why can't we work together? Why can't I just work together, I don't know, with the Dutch, with the French, with the UK, and have exchange of information there? So that is what we're really trying to focus on now again. But then every National Treasury Association is organized differently. Mm-hmm. So I think that is also very important. I mean, like I said, ATEB is really a hobby, right? Which we do besides it. And there are other organizations like in France and like in the UK, which is actually, it's a company. Yeah. People are employed, they have employees, they have, small or big, but so they have full-time people. So it is a different approach.
Karen, amazing. Thank you so much for coming on to Corporate Treasury 101 podcast. Did you have fun?
I had.
That's the most important.
Is there anything else you'd like to add about any of the topics we've discussed today? So whether it's the rating side of things, managing an organization, or being in a treasury role in an organization which has this rating, the transition, which is my main takeaway, was actually the transition is the biggest part. The steady state is fine, yes, but it's really the overnight.
Yes,
that's super cool. Yes. Or ATEB, anything you'd like to add?
No, I think we've covered a lot of ground. I just hope it was interesting. I hope it made some sense in what I was saying. I think, for ATEB, especially for the Belgian listeners, if you haven't heard of it, if you're not a member, join us. It's a fun group, I think. And I mentioned that at the beginning, but we really do like to have fun. We try to stay professional. But it's just, again, a way of getting to know new people in a different environment and to be able to get some knowledge. What I think is great is like you meet somebody you get their phone number, you pick up the phone and say, hey, I'm dealing with this issue. I'm reviewing my treasury policies. Do you have an example for me? I mean, those type of things get done. And so I don't think it shouldn't be considered hard work. So that's really what I wanted to say about ATEB. And then in general about the companies, like I think you nailed it. It's the transition that is the most difficult part. But that's it, I think. Yeah.
Sounds good. So we'll have all the links to ATEB, to yourself as well, in the show notes. And yeah, thank you so much for coming on.
Thank you so much, Karen.
Thank you.
Amazing.